Hello everybody, Ignatius Jackson CPA here on the Ignite Business Talks podcast channel. So today we're talking about an interesting topic, the Kiddie Tax. Have you ever heard of the Kiddie Tax? Did you know your kid could have a tax liability depending on if they have earned income or not? So go ahead and stay tuned. We're going to be right back in a second. I'm going to tell you all about this. Be right back. All right, and we're back. Thanks for tuning in today to the Ignite Business Talks podcast. Okay, so this episode is about the Kiddie Tax. All right, this is an important tax that you really need to know and understand. Okay, this tax is for any kids that are under age of 24. All right, now if they're under 18, it's any kid. If it's under 24, it's certain children that are going to meet this requirement. For example, they're in college, they don't have a full-time job, that kind of stuff. Okay, so there's certain criteria for them that 18 and 24 time period that they're going to meet the Kiddie Tax rules. But if they're under 18, basically these rules are going to apply. Okay, and so if your children have unearned income, meaning they haven't worked for it, like babysitting, janitorial services, working at the grocery store, all that kind of stuff, right? So if they haven't earned income, so think about stocks, rental real estate, dividends, bonds, that kind of stuff, okay? So certain types of activities like that. So if they don't have earned income, okay, or if they have unearned income, that's greater than $2,500 in 2023, then voila, they get put into this Kiddie Tax issue, okay? And so one of the things we want to do is avoid the Kiddie Tax as much as possible. Why? Because it's taxed at the trust tax rates, which are crazy insane. All right, so it jumps up to the top bracket of 37% real quick. And so we want to make sure that we are, as much as possible, avoiding having to pay the Kiddie Tax. And so we're going to talk through a few ways that you can do that in this video today. Okay, so first, one way you can do it is exploit that threshold, okay? So you just basically strategize and work with creating investments and accounts and stuff like that that don't have income that exceeds that threshold, okay? So if you do that, then voila, you don't have to worry about the Kiddie Tax, okay? Another thing you can do is buy Series EE US savings bonds. So the reason for that is because the interest doesn't get paid out on an annual basis. It only gets paid out when it matures. And so if you get a long-term bond that doesn't pay out the interest until they get to a certain age, right, where they're not subject to the Kiddie Tax anymore, then voila, you also have some good tax-free income there, okay? Also, 529 college savings plan. That's another great strategy that you can use to save yourself on the Kiddie Tax by investing in a 529 college savings plan. Okay, I've talked about this before. Basically, you can contribute up to your gift tax exemption each year without having to worry about filing a gift tax return or anything like that. And you contribute that to your 529 in the name of the kid, and that money can grow tax-free as long as you use it for educational activities. Then you don't pay any taxes on the growth that's inside that account. The downside to the 529 plan is it's a very low growth rate typically, because they're investing it in very safe investments. And so that means your growth rate is going to be down here when it could be up here by doing some other investment strategies. But nevertheless, it's a way to avoid the Kiddie Tax, okay? Another thing you could do is invest it in some certain life insurance products. So if you buy a certain type of universal life policy or something like that, that allows you to invest the funds that are inside of there and grow it in a tax-efficient, tax-free manner. That's another great product that is available to you. And you could even take loans in these types of accounts and save yourself some money on your taxes when you need to go and pay for something down the road, whether it's college cost or whatever the case might be, okay? And if they're in that 18 to 23 year range, like I said, if they have earned income that exceeds 50% of their support for the year, then they also do not have to worry about the kiddie tax. Okay, so one last one that is last but not least is if they have earned income, they can also put into a Roth IRA. So investing inside of a Roth IRA instead of investing in a taxable account also helps to completely avoid the kiddie tax, because the income that's inside the Roth IRA is non-taxable in any way, shape, or form. Doesn't matter how old they are, doesn't matter whatsoever, okay? So they're gonna be able to pay no income taxes on that growth that's inside that Roth IRA all they want, okay? So that's like the best of the best of the best ways to avoid the kiddie tax, is by putting the money into a Roth IRA. You can do up to $6,500 a year starting in 2023. And again, the only criteria really for that is they have to have earned income that exceeds how much you're putting in to the Roth IRA. Okay, doesn't mean that's where the money has to come from. Technically, you can still gift them $6,000. They can use the money that they earned, and you can gift them the $6,500 to put into the Roth IRA instead of putting it into a taxable account that's going to ultimately potentially snag them with some kiddie tax. And so I'm actually starting to see people get hit with this, because I have a lot of people who have created these UGMAs and UTMAs so accounts for their kids, and not realizing, oh, they might have to actually file a tax return for these. So yeah, so if the income's above a certain amount, you have to file a tax return. Now, if you're managing those UGMAs or UTMAs, okay, then you typically can decide what type of stocks you're investing in. So you can choose stocks that have low or no dividends. Okay, you can choose stocks where you're going to hold them for a long time period and you're not going to sell them, creating a capital gain or something like that, right? So there's definitely ways you can structure an UGMA or UTMA if you want to use those instead of the Roth IRA, or if you can't use the Roth IRA, or one of those other options that we talked through don't make sense to you. So that's definitely available to you. However, if the Roth IRA is available, that would be my first choice. And if you have extra money you want to contribute to the kids' future, then an UGMA or UTMA is probably another good choice. Or you can do the life insurance product, savings bonds, one of those sorts of things, okay? But the key is, if you're using the UGMA or UTMA, just make sure you're managing it so that you don't have income that's exceeding that threshold, and you don't have to worry about it. Okay, now, if you do have the income that exceeds the threshold and you're subject to the kiddie tax, okay, there's two ways you can basically report it, okay? One way, the kid files a tax return, they pay the taxes based off of their parents' income tax rates for the portion of the income that's above it, okay? Second way is you can, and I do have to correct something I said earlier. It's not the trust tax rates that they're paying, it's the parents' income tax rate. I apologize, I said that incorrectly earlier. Let me correct that before I finish this video. So it's going to be the parents' income tax rate that they're paying. And so if the parent has a super high income tax rate, like in the top bracket of 37%, for example, then that's where that income is going to get taxed for the portion that exceeds that threshold of the $2,500, okay? And so they can file their own return and do it that way. Or you can file, they can file a return, not file a return, and the parent can elect to file their income on their return along with them. But there's certain criteria in order to be able to do that. It has to all be certain types of income. And so if they have other income that doesn't meet that criteria, then that option doesn't actually exist, and the child has to file their own return. And in some cases, the child filing their own return actually makes a lot of sense. And so, so in that case, if that's the case, then go ahead and just do that instead of taking the easy option of just putting it onto the parent's return and going from there. So that was the video for today. Hopefully that was enlightening. I know it's not something that people talk about all the time, but it is something that I think as you continue to build your financial freedom in your journey towards generational wealth, once you get to a certain point where you're good with yourself, then you may want to start to contribute and start a little stockpile for your children as well. And so here's some tips on some things that you can consider so you don't get hit with some big tax bills that you didn't expect from having your kids invest in certain types of activities. So that was the video for today. Hope everybody enjoyed it. Don't forget to like, subscribe, share, tweet, whatever. However you want to get this information out. I think it's super critical and important information. So definitely listen to it, check it out, and tell all your friends and family about it. And hope everybody has a good one. Peace.